Hi, I'm Joy Macknight, Deputy Editor at The Banker, and I'm here at EuroFinance in Vienna with Michael Spiegel, who is Head of Trade Finance and Cash Management Corporates for the Global Transaction Banking at Deutsche Bank. Thanks so much for joining us today, Michael. Can you tell me really how the transaction banking landscape is being transformed?
Well, very happy to, and thank you very much for having this chat. I think in order to look at how the transaction banking environment is going to change, we need to understand what drives the change. And there are a couple of mega trends that we see evolving. Certainly you have a lot more geopolitical unrest, you have a lot more growth challenges in terms of economic growth. You have also a much bigger challenge in terms of the regulatory framework for corporates as well as transaction banks. And unfortunately, we also have negative interest rates. So all of these together put quite some stress on the broader corporate treasury community, and this is what transaction banks in particular need to respond to, because we want and we are partners to our corporate treasurers in providing solution to our corporate clients. So we're looking at those trends, and we're looking at who else could we use in terms of providing services. And you see that the banking side also has a bit of a challenge, or new market entrance, shall we say, through, let's say, call them fintech companies. And I do believe that this will put a little more, will give it a little more impetus as how it's going to change.
And how are your customers' expectations changing?
Well, given those mega trends that I was briefly talking about, our clients would obviously like us to work in a partnership, and we see, on one hand, we supply solutions, but you see actually, and we in the discussions with our clients quite often, we find that they're looking at us much more as a partner in these ever-evolving, with these challenges. So they're looking at us, for instance, let's look at technology, for instance, right? So technology, you have so much new development, so many new news about distributed ledger technology, what do we use, how much can Treasury use that, to what extent can corporates use it. And in Treasury, you can only use what is proven. So our approach to this, for instance, is that we're working through innovation labs across the world to take a look at how we could actually make use of that technology in order to better solve for the needs of our clients. And it's not only what would intuitively be a banking solution, it may actually very well be a solution for corporate. So I'll give you one example. If a large corporate has a very large, or any corporate has a large banking relationship, a large trading relationship with another corporate, and that corporate changes the account number, it is actually quite a process for the other corporate to verify that that was truly that corporate who gave that information. Because we know all that there are CEO phishing emails with the banks, with other corporates, so they need to make sure that it's truly the new account number. So there are actually matters that we need to think as banks in a much broader context, rather than simply look at what typically would be a banking product.
So I know Deutsche Bank has recently done a corporate treasury survey. Can you tell me a little bit about the main findings?
Yeah, so we have teamed up with the Economist Intelligence Unit and have done a survey globally of about 300 professionals in the Treasury and Finance departments, about 150 CFOs, 150 treasurers or professionals in the Treasury departments. The main findings are actually quite common across the globe. So one is a reduced global growth. So there's actually concern around the growth expectation from an economic perspective. There are certainly the challenges around the interest rates that are getting lower and lower, and quite a number of jurisdictions are negative. There is a concern about how to use new technologies in the Treasury departments, to my earlier point. There is quite a concern around the increasing amount of regulation, not only on the banking side, but also on the corporate side. So there's volumes and volumes and volumes of data that is being produced, and not everybody is entirely convinced that it's necessarily going to make the world a better place, because we don't know how to use that technology. So they're global mega trends, and they actually coincide with our views. So we now need to work through those.
Okay. And how do you think that corporates can best use their excess cash?
Well, that is a very good question these days. I mean, why is there excess cash, right? There are a couple of different reasons. So right after the financial crisis, and still pertinent to some extent in the corporate world, is it acts like a buffer. So what happens if growth doesn't come? What happens if we face some challenges? So there's a capital buffer, there's a liquidity buffer for excess cash. Then there is excess cash where corporates don't find the growth opportunity, so I would say there's a delay in investments, right? But the cash has not yet returned to the shareholders because there's an expectation that the corporates will find that growth. Those are two different scenarios, right? In the first one, I think the excess cash, certainly with negative interest rates in many currencies, is still a cost factor, but it's probably a more digestible cost factor. In the second instance, it is a bit more of a challenge. And we're working together with, management funds, we're working together with alternative management funds. It is a complex theme, and there's no simple answer in terms of how to get the best yield out of a euro these days.
Well, that's great. Thank you so much, Michael.
My pleasure. Thank you.